Hello and welcome to our video interview series with some of the most important players in venture capital from across Europe. I'm Dennis, I'm the Managing Director of Faraday Venture Partners in Germany. And today we'll be talking to Sascha from Vorwerk Ventures, a corporate VC turned independent. So hello, Sascha, thank you very much for your time. I would like to give the word straight to you and ask you to tell us a little bit more about yourself and also about Vorwerk Ventures, especially the value proposition that you have, well, on one side, obviously for your investors, but also for the entrepreneurs.
Sure. Thanks, Dennis. Thanks for inviting me here. I'm very excited to be part of your journal, your video blog. Maybe a couple of words about myself. So I'm Sascha. I'm principal with Vorwerk Ventures. Initially started my career in consulting, like as a good business school student you have to do. So I was 3 years in consulting before I decided to leave that space and join the startup ecosystem. After my master's degree in between, I joined Project A Ventures in Berlin, built up the investment team there for 2 years, because they were currently transforming from an incubator towards an operational VC. So I didn't have that much of startup experience, but maybe the structural background of the consultancy helped a lot, because back there I learned a lot about startup ecosystem then. After 2 years, though, I decided also to step out and do something on my own. So I co-founded a startup, Yidu Travel, which is a B2B2C travel platform, which was funded by Lufthansa Group. Run the startup as COO and managing director for 2 years, grew it to 70 people, but unfortunately due to Corona, wasn't the best time to run a travel startup back then. So unfortunately had to send the majority of the people into short-time work, and also myself decided to leave the company and joined Vorwerk Ventures then last May. And you might think, okay, why Vorwerk Ventures? Why do you want to go back into the corporate world? That's not the case. So as you mentioned initially, Vorwerk Ventures is not a corporate venture capital fund anymore. We are an independent venture capital fund now based in Berlin. And one can think because of the name that we would still a CVC, but nevertheless, we aren't. So maybe in general, to give you a little bit of background of who we are. So we exist since 2007. And back then we were actually the investment arm of the Vorwerk Group. And maybe for the listeners who do not know Vorwerk Group, it's a family-owned business here in Germany. And I think the most famous products are the Thermomix and the Cobalt vacuum cleaners. Nevertheless, they own a lot of different firms as well. Like they own a D2C cosmetics line called Jafra. They own a robotics firm as well as a bank. And I think what is good with Vorwerk is that they realized pretty early on that there's a huge potential in startups. So they started investing in 2007. And when I say they, it was mainly Dirk and Norbert, the two general partners also of the new fund. And they were quite successful. So they were early investors in Flaschenpost, early exit investors in HelloFresh, both unicorn exits in Germany. And also beyond, built a nice consumer portfolio or consumer-oriented business models that were quite successful. And so that being said, in 2019, they decided to spin out the fund in order to get to the next evolution level. And since then, we're entirely independent in our decision-making process and purely financially oriented, and not a strategic impact anymore in our decision-making. Maybe about the fund itself. So we are 8 people. We are Berlin-based. In short, we have 150 million to invest. Normally, we invest up to 10 million initially and up to 15 million over the lifetime of a company. But our sweet spot is more or less 2 to 3 million, which puts us late seed, Series A. But we opportunistically sometimes go a little bit earlier or a little bit later. And regarding our focus is consumer technologies. So here we differentiate mainly in 3 buckets. So the first one is the classical direct-to-consumer model. Here we have investments like Everdrop, which is, some might know it, the leading sustainable cleaning D2C brand here in Germany. We are invested in Avi Medical, which is basically a next generation GP practice. So everything that is directly directed to the consumer. The second bucket is more the consumer in a professional environment, so B2B2C. And here we invest, for example, in Sharpest, which is an employee coaching platform. And last but not least, also a little bit the B2B angle that we have is enabling technologies. So everything that enables brands or basic retailers to serve the customer better. And here we put in basically all our B2B models currently. We have some in the old fund, and for the new fund, we are currently looking at some interesting stuff there. And I think in the end, what needs to be the red line of all investments is that the consumer must have a clear benefit. Consumer must always be in the equation, and we would not invest in pure B2B process optimization plays. And maybe regarding the sector, we are sector agnostic, we're industry agnostic. We have some fields that we personally find interesting, and then we also maybe did some deep dives during the Corona times, as there was not that much deal flow. And here we had a detailed look, for example, in digital health. So I did that personally because also back then at Project A, I was involved in investments in Krü and Clara, and really find this space super interesting. We did the first investment of Ivy Medical in that space. And so this is a topic that I really much enjoy. The same goes for social commerce. We like food tech. We recently invested into a plant-based brand for producing chicken. Education is a space that we currently dig deeper into, and as well as, based on my background, next generation travel and mobility. But here I think it will take a little bit longer until the investment ecosystem will rebuild again after COVID. I think what the other asked was the value proposition, right? So, well, let me divide here maybe in pre-investment and post-investment. So the ones that we are not invested in yet, and the ones we got lucky to get in. Well, pre-investment, I'd say we know that the fundraising process, like from own experience as well, is very extensive and takes a lot of time. So what we're trying to do is to give a very clear proposition, give a very clear and honest feedback, and do not prolong processes extensively. And that being said, we're also trying to be fast. So last deal was first call to term sheet within 5 days. Of course, not every deal goes as fast, but we try to be like very much focused here on the process. We are very flexibly internally. So we have a lot of freedom for our team members, a lot of, we can decide a lot of on our own. We don't have a traditional investment committee process where you go through maybe a partner presentation in the end, but we decide as a team, and if we really like it, we try to make the process as lean as possible. And post-investment, I think here is where it gets interesting, and I think why startups also should come to us. I mean, here it is, we've been in the market for 14 years, and so I think we bring along a certain understanding of venture investing across all lifespans of startups. So we know how it is to invest in early seed, but we also know how startups look like when they are pre-IPO or IPO, then, for example, with HelloFresh. So there's a lot of experience, and this is also from LP perspective, the portfolio itself has a very good performance. So I think the value proposition to LPs is much clearer, because they mainly look at numbers and see if the returns work out. For the entrepreneurs, though, I mean, given all that experience, we have a good sector expertise, especially in consumer models, and we're continuously expanding this expertise also in additional fields, like I mentioned before, looking deeper into digital health. And here we have a broad network of, let's say, experts, co-investors, partners, and that we can, of course, tap into. Nice. I think from how we work together, I think maybe this is also a little bit differentiating, because I think we're reliable partners. If you ask the people in our portfolio, the founders that we invested in early on, they normally describe us as very reliable and loyal. And this regardless if the venture is going up and everyone is happy, or going down, which of course is also part of the game. And we're always there as sparring partners. We can be very active, like in the sparring. We advise on operational topics and strategic topics. But I think what is very clear is that we understand ourselves as financial investors. That means we do not get involved too operationally, because we believe in strong teams. We believe that we are there to challenge them and basically try to get the best decision possible and be very active here and be available for them. But operationally involved is not something that we will get. So I think that sums it up.
Nice. I mean, I can see from what you just told us, there's a lot of synergies between the two of us, and I think we have very, very similar approaches when it comes to a lot of the companies that we look at. I mean, you and I have constant calls, and we always talk about interesting opportunities that fly around in the German ecosystem. And definitely, I see there's a lot of points where I hope that we in the future might collaborate on one or the other deal. You have already started to mention a couple of things that I'm going to use as a segue for the next question that I would like to ask you, because you obviously said that you are more of a financial investor, that you have, or that you focus on the team primarily also, that you don't want to get involved too operational, and that you actually believe in the teams, which is obviously also a point that we like to look at. We look for founders who have an excellence in, or some deep knowledge within the field that they're going to, or that they started the company within. So the next question from my side towards you would be, what is your real investment criteria? Like when you look at a company, when you analyze them, when you go into, not necessarily within only 5 days, but when you go through the whole process after you send them a term sheet, and then you go into the analysis, what do you really look at? How do you evaluate the teams? And maybe give us some insight if that has changed over the last 12 months because of what we've all been living through.
Sure. But regarding the investment criteria, I think as we are very consumer focused, here we have the first cutoff point. So main criteria is for us the fit to our consumer tech focus. And most B2B companies get filtered out at this stage because if they do not enable consumer-oriented companies, or let's say have consumer ankles. So here it's easier for us to strap down. Furthermore, I think our investment sizes, we're late seed Series A, also gives a certain focus. But within that field, I think the investment criteria is like with any other VC pretty similar. So I think the questions that we ask is, okay, is the product solving a real problem? And is this in accordance also to the investment thesis that we have maybe in that space? So let's say in digital health, we had a clear investment thesis and said, okay, there must be something revolutionizing primary care like it's already been done in other markets. So let's try to find this one, and let's try to take this as a benchmark and see what kind of business models could be interesting in that field. So here, sometimes it's sector expertise and the thesis that we have. The second thing is, okay, is the problem that the company is solving, is this big enough? I mean, we have a 150 million fund, and this might sound big, but we are by far not the biggest fish in the tank, but also not the smallest. So I think that means that we have to invest in businesses that address a big enough market to accommodate for a large enough venture for VC-like returns. So I think here also quite a lot of business models fall out because we just say, okay, the market is just not there yet, maybe in the future. The next thing is, I guess, traction. So is there already a proof of the viability of the business model? And I mean, this always heavily depends on which stage the venture is in. We also sometimes invest pre-seed. Of course, the viability of the model cannot be proven yet. There are more like other criteria that we look at. But a general rule is that if there's momentum, if there's growth, and if we believe that if a company grows in early stages and the consumers or the customers of them not immediately run away from it, so there's a certain retention in the company, is normally a good sign of an early product market fit, and we feel more comfortable basically in investing there. And then, like I mentioned at the beginning, team is most important. We believe that as well. I think a strong founder team always finds a way to somehow mitigate risk, somehow to find ways within a market. But the question is, okay, how can you actually quantify this? And I mean, one thing is that we look at is the experience. Is there maybe some sector knowledge? Has this person not necessarily founded a startup in that field, but maybe worked in that field before, has an expert knowledge that other than that person, no one else has? A lot of people have, but they don't have the courage to make a startup out of it and maybe to step out of the comfort zone. Or maybe, like I said before, the person has already founded a startup, is a second-time founder, third-time founder, so they do not make those early mistakes that maybe cost money in a high execution game. So here it's all about also how the founders represent themselves, looking at their drive, their ambition, their vision. So sometimes you have calls with founders and they completely blow you away because you're like, okay, this is you haven't seen that problem before, but after this call, you're so psyched about that, and those people can actually motivate you. And I think this is also a very important characteristic for a founder, to be able to like motivate people, to lead people, the organization, but also to be able to fundraise in future. So can you imagine that this person actually goes to Excel or some other growth funds and raises a huge round? So of course this should be there. You should at least have the trust that the person can do it or can learn to do that. Then looking at the team, is it complementary? So sometimes you have, of course, 3 business units, which is also fine. I mean, there are a lot of startups that are not that complementary. Maybe they lack this technical expertise from skill level, but they need to be a little complementary from a mindset perspective. So do they cover their strengths and weaknesses? Do they also understand what is missing? Are reflected? Do they understand that they need some other people to complement them? And how open are they to do so? Because you don't want to have a person that believes does everything right and doesn't want to have anyone else, because you don't want to work for such a person. So it's going to be hard to build a team. Yeah. And I think what is super important to us is also kind of a fit to our personal values. We did a workshop last October, and we kind of identified some values that we all feel kind of related to. And those are like being humble, humbleness, integrity, loyalty. So do you have the feeling that you can trust this person and you want to basically spend the next 8 to 10 years in a boardroom with them together? And I think this fact should not be neglected, because in the end it is kind of like a marriage that you start with. So the values, they should be aligned. And last but not least, I think what is important is reference calls, asking people that work with them, and those give normally a very good understanding of how this person has worked in the past, and maybe also will work in the future. And yeah, I think the question is, and the last, maybe aside from the team, to wrap maybe this part up of our investment criteria, after the team, it's the exitability. Like looking at the market, I think for us it's super important that there's a buyer's universe out there. We are exit oriented. It doesn't help to only basically have all the value on paper. At some point you need to exit this, and also you need to understand if the market is ready for that. So I think this is maybe the last criteria, high level, that we look at. And I think what you also asked was how those criteria have evolved over time. And I think especially the last 12 months with the pandemic, I think there are some changes. So maybe let's cluster this up in 2 parts. The first one is more the pandemic specific, and the second one is more the overall trends. And I think the pandemic for us has reinforced our focus on consumer businesses. I mean, we see that this segment has not suffered that much, was partly a winner of the crisis. I'm always hesitating to say a winner, because in the end, no one won really from this crisis, but actually some startups went through it better than others. And looking at our portfolio, I think especially the consumer-driven businesses, they got better. So here we say continues to look at consumer models. We believe e-commerce has a second spring. We look if the models are like crisis resistant. So of course, looking at if they really suffered a lot from COVID, or if they kind of slipped through it. Of course, now you ask different questions regarding this. And I think a special focus is also on the business model itself, is how asset light is the model. So how much CapEx do you need in order to scale it? Because, I mean, raising funds, both equity and debt, in times of crisis, it gets harder and harder. And of course, like in upswings, it's always better to do such things. So we also look a little bit differently at the models and see, okay, is this really super CapEx intense? Do they have enough cash also maybe to have a longer run rate? So I think this is what we look at. And I think from overall perspective, the criteria of the stage, I guess, has changed a little bit over time, because there's increased competition. So of course we said at late seed Series A, initially we said we only invest in Series A companies, kind of. But this gets basically more and more earlier, because you need to speak to the customer, clients, to the startups earlier, and to have to also write tickets at an earlier stage, where maybe you just invest on growth indicators rather than actually traction. Because by the time that the company has reached a certain amount of traction, either the existing investors preempt the rounds, or like big investors from, let's say, UK or the US, come in and preempt those rounds. And then basically you as a German investor, it's difficult. So here, I think that the overall trend says go earlier and get to know the teams earlier as well.
Yeah, that's a very interesting point. I mean, that's sort of where we also try to sort of jump into that gap of being with the founders pretty early. Always try to see that they already have some type of traction, obviously, to make sure that there is a certain type of market validation and product validation within their customers. But I completely agree that the last 12 months have to some extent changed the way that we look at companies. And I also have to say, though, from our perspective, that I completely agree with the point that you said, that nobody really was a winner, but some just took advantage of the situation or were actually set up to take the time and have the runway to sort of navigate through this difficult time. And I think what was very important from our perspective during that whole period was, or still is, was to say, obviously there are going to be companies that will be created out of this circumstance now. So let's have a look at them, but not only look at them if they could thrive in times of crisis, but also after the pandemic. So I think that is also something very important, where a lot of companies have jumped onto this train of saying, okay, we have a very, very pandemic specific solution and we want funding for that now, and have never asked themselves the question, what is going to be after that? So I think that is something very important to look into as well.
Totally agree. Yeah.
So we mentioned a couple of times already now, also in your introduction, that Vorwerk used to be a corporate venture capital fund. And I mean, most of us who come from the venture scene or from the startup scene, they will probably know what a corporate venture capital fund is and what an independent venture capital fund is. Some of our viewers might not. So I think it would be great if you could just give us a little insight from being inside one of those transformation processes. What are the differences, pros and cons that you would like to highlight? And maybe also why Vorwerk transitioned from a corporate fund to an independent one.
Yeah, sure. I think let's start with the why, because it's a good question. Why should Vorwerk actually do this? And I think this was also, like I said at the beginning, based on the success that Dirk and Norbert, the two GPs, had at the very beginning. So I mean, they started really on in investing. They got a lot of trust from Vorwerk Group to actually do venture investing. And they saw that this business or this line of business flourished. So they multiplied their capital invested and saw that there was a big success. So they also said, hey, let's intensify a little bit those VC activities. And we say a little bit, they meant really like go big with the VC activities that you're doing. However, this cannot just be done in the structure of a corporate VC. So maybe now going a little bit deeper into what does a CVC structure look like. I mean, there are different ways, but I now describe just the way of how Vorwerk Ventures was structured back then, or back then it was direct selling ventures. Well, before we invested in an evergreen structure, and I think here evergreen means that we have money available to invest in, but there's no certain lifetime of when this money needs to be invested or divested. And the investments were done off the balance sheet, meaning that it is actually changing the EBIT of the company if they start to invest this year or not. So it is always dependent on if the company currently has a good year or bad year, and really have the focus on investing into activities. Vorwerk always, like, they stayed strong from 2007 to 2019 and were continuously committed to invest. So that was not an issue. But it has kind of a dependency on how the company is standing there in the market. Back then, we also were financially oriented already. So our goal was to make out of €1, €3. But there was also kind of a strategic focus. So, and this was preset by the corporate. There's this, like, our strong focus on consumer technology is always, of course, it comes from our heritage. But we back then was said, hey guys, we are a direct selling company. We basically invented direct selling here in Germany. Let's look into some kind of models that are similar to this. This could also help us strategically. Nevertheless, they always had kind of a financial mindset regarding this. And also back then there was an investment committee, and this was not just Dirk and Norbert. So it was the management board of them. There was a board that decided on each venture, and as you can imagine, it takes a little bit longer if you always have to go through those loops. And so you're kind of constrained to the corporate regulations. And I think now, looking at the structure from back then and looking at the structure now, you will see the differences. And then here, for example, the first thing is that we now have an evolution. It's rather an evolution than evolution, an evolution rather than a revolution, because like I said at the beginning, they wanted to make it big. They had a high commitment to venture capital. However, the structure just doesn't work and doesn't go well with it. So what we changed now is the structures. We have a market standard LP-GP structure with a diversified LP base. So it's not only Vorwerk Ventures that Vorwerk that invested in our fund Vorwerk Ventures, but there's also some high net worth individuals that co-invested with Vorwerk. Of course, Vorwerk Group is still the largest LP for this moment, but we're looking to diversify that also even more in future generations. But at some point you need to start, right? And the second thing is the fund lifetime. So we are with normal market LP-GP structure. You also have a fund lifetime, which is ours is 10 years with the opportunity to extend by 2 years. Mm-hmm. And there is now, because of this structure, a new decision-making committee, which is actually the fund management now, the team. And the last thing is that we extended the team. And maybe let's go through those points step by step and maybe look at the pros and cons. I personally, of course, see more the pros, because I also was a part of Vorwerk Ventures before that transition. Mm-hmm. But of course, there are pros and cons to it. So let's say the market standard LP-GP structure with an LP or with diversified LP base. I think the advantage is now that you have a clear structure between right and duties between LPs and GPs. Limited partners provide the money. GPs basically are responsible for investing it into the asset class, into the assets itself. And with everything that also comes along. So there's a different incentive structure. And I think we can get more interesting parties in our funds that can support us. So with a multi-LP base, you're able to, let's say, get some experts in that can also help the startups, help yourself, and basically support you in a way. The con, of course, is this fundraising. We are in a normal fundraising cycle, so we're going to raise the next fund. I guess we need to start next year as well. So there's not this traditional evergreen structure that there's money flowing in, but there's actually stuff that you need to do, which of course though is also positive. From a fund lifetime perspective, like I said, so we are now limited to 10 years, which is normally divided into some years of invest, 5 years invest, 5 years divest. And the advantage here is that you can be measured against other funds. So we are not comparing any more apples to oranges when speaking about the performance of a corporate VC versus a normal VC. But now you can actually understand, okay, there's a vintage of the fund, how has it developed? And given our performance in the past, we are also quite optimistic that we will continue this performance. Of course, it needs to be proven, but we are also then more attractive maybe to external investors. The negative part of the fund lifetime, though, is also that we need to divest at a stage. So that means that some models we cannot do anymore, or basically we cannot invest anymore because there's no clear time horizon. Maybe some startups that are really early and are in very experimental fields, it takes longer for them to fully materialize than those 10 years. And of course, you always have the possibility to extend, but you cannot wait until the asset is improving in value, but you have to divest at a point. So it also kind of limits you. Also, depending on the later it gets, the time that is left in the fund until you start to divest gets reduced. So you cannot entirely harvest the full value. But I think this is a con that you have to take into consideration and change a little bit in your investment focus. Their own decisions that comes along with the structure, I think there's only a pro. We are faster. We can decide in the team, and I think we do it quite democratically. So in every team meeting, we discuss together and decide if we're interested in that. And if there's a thumbs up, we are quite independent also in the execution. So that gives us a lot of freedom, this new structure. And regarding the team, I think in order to intensify those VC activities of Vorwerk Group, it was important to get the team bigger than 2. And here we now extended, like I said at the beginning, to 8. And this is only possible to get good talent, well, if you have, well, the incentivization or the incentive structure, and that you are not maybe a corporate. I think typical Berlin talent is not, or VC talent is not that much attracted to corporate venture capital funds, because there is still this corporate component that is most of the times, or very often, seen as, oh, this is the bad thing. I personally don't see that way. I mean, there are pros and cons on that side, but I can imagine that if you want to attract talent, if they have the chance to go to an independent fund or to go to a CVC, they will always go for the independent fund. And that being said, I think this would not have been possible without this new setup. And so we also extended here and got really cool people on board, and it's really fun to work with them. So overall, nice. I think looking at it, it is currently with Vorwerk Ventures the best of both worlds. So on the one hand side, we have a very dependable and loyal LP that also like understands VC and continues to invest here. And we can combine that with speed, with a top team, and actually, a new start kind of.
Cool. Yeah, that's some very interesting insights to sort of get the comparison between those two models. When you started talking about becoming an independent and now being independent, with the difficulties and the challenge of having to fundraise, I had to think about the last 6 to 9 months for us at Faraday, because we've also been fundraising for our first own fund, our flagship fund, which we did the first closing in December, and we're still fundraising at the moment, both in obviously the different areas that we're in Germany and Spain, and it's going really well. But it is very, very interesting to sort of get into that fundraising, talking to the high net worth individuals, to corporates, etc., to that LP base, and tell them your vision. Where are you going with this whole thing? And it's ever so rewarding to get the positive feedback and the support from those LPs to then actually push your vision forward. So I saw a lot of parallels when you were just talking about the advantages and the challenges of being independent. So very, very cool. And I think I also agree on the fact that the CVC isn't as sexy as some might think. But then again, there's some nice examples out there of corporate venture capital funds that are working very, very well and that have very cool structures within. So I think they're not to be forgotten when somebody looks to get into that field.
Definitely not. Yeah, that's true.
And maybe then to wrap it up as a last little question, we've already touched on this a couple of times during our conversation on how COVID and the pandemic might have changed your thesis, which you said it has not necessarily changed the thesis, but reinforced how you're focusing more on consumer-oriented products, because that has been a field that is, let's say, less affected, because people still purchase and even more purchase online in that second spring of e-commerce. Nonetheless, would you say, or what do you think is going to be the future of venture capital? I mean, we've seen effects of this. Everything is on Zoom meetings. The last investment that we did at Faraday in Germany, which has just recently been closed, we didn't even meet the founders in person. So what do you think is this whole situation going to be or mean for the future of venture capital?
Yeah, let's divide this up in the 2 parts, like the impacts of COVID and how that changed basically our thesis, and then going forward, future of VC, because I think they are not entirely interconnected. I think they have some interdependencies, but I see both basically a little bit separately. So from COVID perspective, like I said at the beginning, I think that the whole pandemic has reinforced and basically confirmed our investment thesis to focus on consumer-oriented business models. So looking at our portfolio, we had substantially higher valuations for D2C models, or models that are directed to the consumers, rather than to the other ones. And I think even like in such a pandemic, we managed to exit one of those D2C models to one player for a substantial amount. So I think here we felt that we bet on the right horse and say, okay, consumer is difficult to find the right one, but especially in such pandemic times, it can be also beneficial to not be like dependent on corporate budgets, etc. I think what changed in the cooperation with the startups, actually not much, except for the fact, of course, that you cannot see them anymore. And yes, we also did our deals where we haven't met the team once. But I think I personally don't see it as that like a harsh criteria to get to know the people in person, and because I hope the way they are through video chat is the same way they are in person. And of course, I hope to meet them at some point and have a beer together and finally have that closing dinner and get to know each other better rather than just through a Zoom call. But other than that, for us, that didn't change much. Like I said at the beginning, we look a little bit more detailed into, okay, is this round big enough to, like, is it necessary to only have 12-month cash, or can you maybe extend it a little bit longer so that you have cash in the bank? Because I think this is what we've seen during the pandemic at the beginning, is there was a stop of investment a little bit. People were quite cautious, and that really did not help the startups. So those startups that said cash is king and focus on that one, they were in a better situation. So we're trying to anticipate that, but maybe this is something that we now have a look at. I think going forward and hoping that with the vaccinations, this whole COVID, at least from the intensity that it is now, it will be over at some point. I think venture capital will bounce back rather quickly to the old high that it was before the crisis. And also we see throughout the pandemic, even though there was quite a hesitation at the very beginning, there've been super huge funding rounds so far during that crisis, some acquisitions during that crisis. So I think this will bounce back rather soon, and this will have a very strong impact actually on us as a fund in the future of VC, because I think, but looking from focusing on Germany, which is mainly our focus region, I think there will be a further professionalization of the ecosystem. So there's new funds that are being raised. There's money flowing back from founders that made their exits because, there's more liquidity in the exit ecosystem. There is VCs that had success. I mean, they were quite successful funds in Europe, where the money also flows back into the ecosystems. There are larger funds that are being raised. Looking at HV Capital now having a growth fund. I think here, subsequently, the growth gap that we had before will be filled more by domestic investors rather than waiting for, let's say, UK and US investors to fill that gap. So I think there's a further professionalization also in terms of stages. I think in seed Series A, we have a lot of money, but also this money will be distributed a little bit more in later stages. We also see that, or also believe that, there will be bolder moves. So I think now we had the first $1 billion exits in Europe, and basically make the VCs then also willing to take more risks, understanding that there is now an exit market developing, and you do not have to only invest in the US in order to get $1 billion exit. So it's also possible in Germany, could also be possible in other European countries. So why not basically making bolder moves? And that also means that making bolder bets at earlier stages, and looking at the current fundraising dynamics in the quick commerce space, for example, with gorillas, etc. There is a lot of movement currently happening. And let's say from that, both things, both the professionalization and the bolder moves, make the whole VC more competitive. I think VCs have a lot of money in the bank, low interest rates, a lot of capital is flowing around. Every fund focuses earlier. There's some funds that now focus even on angel investment stages in order to attract the best talents as early on. So I think it is more important for the funds, or for us as well, to get more educated about the spaces so that we are enabled to make those bets even earlier. Because I think by the time that we see traction the way that we would love to see traction for those hot models, I think by then the deal will be gone. So we need to be faster, we need to be more educated, and actually be able to compete here in the future. And I think maybe one step is also interesting with you guys. Our reaction is also that we're looking into different ecosystems outside of Germany. So I mean, as I said, I didn't mention at the beginning, but I studied my master's degree in Barcelona. So I have a natural connection to Spain. And we are looking further now to expand our footprint into those ecosystems, Spain and Portugal. We see that there's a very young population. We see this ecosystem over there growing. Valuations are comparably lower than to Germany. Let's see how long that will take until they catch up. But nevertheless, we see also with the good universities a very, very interesting talent base developing. And we're also thinking about expanding our footprint a little bit more, get a network over there, so that maybe in future fund generations, there is a Southern European fund or something in order to get a little bit away from the current density of the German VC ecosystem.
Okay, thank you very much. I mean, first of all, you have a network in Spain, just you know who to call. And so if you, I mean, we're already in exchanges here. So I think let's see what we can do here in the future. I agree with a lot of the things that you just said, and especially I have to say that, I mean, times of crises and are always moments of opportunity, and I think this is something that a lot of funds are seeing, a lot of startups are seeing, that now is the time to actually take those steps, take those leaps forward, invest in entrepreneurs, invest in companies that have a vision for the future. And I think the most important thing is, and you said that as well, about when we talk about the time span that our funds are actually set up for. We're not in the short-term game. I mean, 10 years is respectively long. And I think a lot of the people who are investing in venture capital today are the ones who have a vision for that future, medium to long-term vision. And I think that is something very important, where we also, and that's the education part that you mentioned, we also have to have a look at what our future market's going to look like, rather than just looking at today. So that was some very, very interesting insights there from your side as well to what's ahead. Sascha, thank you very, very much for your time. It was a very, very nice chat. I really enjoyed it. And taking into consideration that we have never met personally either, I hope that we can actually make it for that beer together at some point. And who knows, it might be a closing dinner in some company that we invested in together. So thank you very much, and I hope you have a great day.
Thank you, Dennis, also for your time. Thank you for inviting me. It was great. And yeah, also looking forward to finally have that beer with you.
Cool. Thank you. Bye-bye.
Bye-bye.